everyone, welcome to Bookkeeping Made Simple. This is the Bookkeeping Made Simple podcast. My name is Donna and I am the president and CEO. Today I want to talk a little bit about what's about to be what's on everybody's mind as we get closer to April 15th, and that is, what is your tax rate? How much should you expect to pay in taxes, and how do you figure that out? So we hear a lot about your marginal tax rate, your effective tax rate. We know about tax brackets. The income tax in the United States is a progressive income tax, and that does mean that the more money you make, the higher you are, or the higher percentage that you pay in taxes. So it's important to understand, one, what bracket you're in and how you figure out both your marginal rate and your effective rate. Now, this is kind of important to me because I remember back in the day when I was working for a healthcare system back east, and I have always been very ambitious. I have always been anxious to, and I do believe it is your responsibility to earn as much money as you possibly can, so long as you do that legally and ethically. So I was working in this office. It was my first real accounting job, and I had just gotten a raise. I was really excited about it. I was planning ahead. I knew that I was going to be leaving that job in, a few years because I wanted to come out to Utah and go to college and, have my life be different from those of my colleagues. And I talked to one of the ladies, and she said she didn't want any more raises because she would be pushed into a higher tax bracket, and that would cause her to actually pay more in taxes than she would be receiving in a raise. Now, we did not do taxes at this particular job, and basically what we were clerks. We were responsible basically for billing insurance and collecting any co-pays. This is back in the 90s. Anything that was left over after insurance paid, we were responsible for collecting. So it wasn't like we were doing income tax for a living. I want that really kind of set out there. So I kind of understand where she was coming from. But this is a really common error in thinking. Number one, my take on it is I want my tax bill to be as low as legally possible, but as high as I can afford for it to be. Why? Because in order to have a high tax bill, I have to have high earnings. So let's talk about what your tax bracket is. And the difference between your effective tax rate and your marginal tax rate. Okay. So you need to understand this because you need to know ahead of time how much of your money is actually going towards income tax. By the way, I'm talking exclusively about income tax in this video. So don't worry about sales tax, payroll tax, any other kind of tax. We will cover all of those later. But right now, we're towards the end of January. People are starting to think about income tax. So a lot of people in the government, particularly in the IRS, have the attitude, and it is kind of codified, that your earnings are theirs, and they just graciously allow you to keep part of it. And there's some truth to that. I hate to say it. There is some truth to that. We need to make sure that we know how much we should expect to pay. And I'm going to go into how to figure that out as part of this. So your tax bracket, and this is specific to the United States, is the range of income that's taxed at a specific rate. So kind of going off of 2023 numbers, I know we're getting ready to file 2024s, but going into 2023 numbers, if you're single, the first $11,000 of your income is taxed at 10%. The next bracket, So from $11,001 to $44,725 in 2023 was taxed at 12%. From 44,000, and this is for single filers, $44,726 in income to $95,375 in income is taxed at 22%. And the rest of the tax brackets are going to, and these are for 2023, are going to be posted in the blog post at mysimplebookkeeping.com/blog. And keep in mind that these rates vary. So if these are for single filers, if you're a head of household, married, filing jointly, married, filing singly, that's going to change. If you're a qualified widow, that's going to change. But you need to understand kind of how they work. So what it does not mean, okay, I'm not going to take your income and multiply that by 22% and come up with a tax. I'll do that if I'm doing immediate, quick and dirty tax planning. The reason why is I want my clients to be prepared for a much larger tax bill than I expect them to receive. Okay? And that means that they will be more aggressive in saving up, hopefully, for their tax bill than they would if they were actually figuring their actual tax. So I will kind of figure taxes based on the highest bracket. However, not all of that income gets taxed at that high bracket. So again, your first $11,000 in income is taxed at 10%. The second bracket is taxed at a higher rate. So in order to figure out how much you are going to owe, the first thing we have to do, if you own a business, to figure out how much you're going to owe in taxes, we have to figure out what your revenue was. We need to figure out what your expenses were. And most people already know what that is. Okay. Then we have to add in any W-2 income, any side gigs, any other income coming from other sources, as well as any expenses that we can deduct. When we figure out, and that leaves us with the taxable income. Not all income is taxable, by the way. I know the government says it is. I know we all think it is, but there are things that are not taxable. For example, if you're receiving credit card rewards, you're getting cash back on your credit card. For most people, that's not enough to worry about, but it's not taxable income. If you receive a settlement from a life insurance policy, particularly due to death, that is typically not taxable income. There are exceptions, and like most things with accounting, the answer is always it depends. But first we have to figure out what your taxable income is, and then we start figuring this out by bracket. So if I have a client, and let's say they do make $95,000, and they're single, and that is their taxable income for the year is $95,000. Well, if I have to figure out by hand, most of the times I put it into the software and let the software do the calculations because I'm not a glutton for punishment. Although I know how to do taxes by hand, I'm not going to be doing that. What the software will do then, or what I would do when I had to calculate this by hand, is I would figure out, say I have a single filer, no kids, no dependents, $95,000 in income. And I'm going to go off of the 2023 tax brackets that are published on my blog. So he makes $95,000, or she. And that's their taxable income. So what I'm going to do is I'm at 95,000 plus 11,000. The first 11,000 is taxed at 10%. So I already know first 11,000 they're going to owe 1,100 in income tax. Then I'm going to take that leaves us with $8,400. Well, from $11,001 to $44,725 is taxed at 12%. So I'm going to take out 11,725, and that leaves us with 39,275 left over. So stop and think about how to solve this. So we have the first minus 11,000 is 8,400, or 80,000 is 4,000, 84,000 minus, and then the next bracket is 44,725, and that leaves us with 39,275. Okay, so I have now the 44, let's see, and then 44,725 minus 11,000 that we've already taxed is 33,725 times 12%. So I have $1,100 from the first tax bracket. I have $4,047 from the second tax bracket. In other words, the first 11,000 was taxed at 10%. The second bracket, just that bracket. So instead of saying, well, now I have 44,725 left, I have to also figure with the first 1,100 or 11,000 that's already been taxed. So that leaves me with 33,725 that's taxed at 12%, second tax bracket, and the remaining 39,275 is taxed at 22%. And that's 4,713. Now we're going to add these up and figure out from there and this person's for a $95,000 income is going to have a tax bill of $9,860 approximately. Now, I just got through telling you that their marginal tax rate, their highest tax bracket is 22%, but their effective tax rate is not. So if I say 95,000 divided by, whoops, $98.60. Their effective tax rate is about 10%. Why does it work this way? Well, because it's not a flat tax. We're not taxing the entire income at 22%. We have brackets, so we just tax the first section at 10%, the next bracket, and only what falls into that bucket is taxed at 12%, and then the next bracket and only what falls into that bucket is taxed at 22%. So you can be in a very high tax bracket, but that doesn't mean that that is what you're going to be paying on your tax bill. You're going to be paying, you'll talk about your marginal tax rate. So your marginal tax bracket is your highest tax bracket. If you make $95,000, you're going to talk about being in the 22% tax bracket. If you make more, you're going to be in a higher tax bracket. And if you make less than, 11,000, you're going to be in the lowest tax bracket. So my colleague that was saying that if she earned an extra dollar an hour, she would lose it all because she would be going into a higher tax bracket was incorrect. She might, because she was a W-2 employee and so was her husband, and that's the most expensive way to make money there is. But she also might not have, her effective tax rate has nothing to do with her tax bracket, or very little. So the effective rate is the percentage you're actually paying on your income. So, if your taxable income is $50,000 and you owe $6,500 in federal income tax, your tax rate is not clear on my screen. That's what it is. So effective tax rate equals total taxes owed. Well, the equation's on my website. But what it means is that even though you may see that you're in a high marginal tax rate, that doesn't mean that that is the actual percentage you're going to pay on your income. So the marginal tax rate is what your last dollar of tax or last dollar of income is taxed at. Your actual tax rate is, we will sit down and figure out how much or what percentage you're actually paying in income tax. So just some key differences between your marginal and effective tax rates. Your marginal tax rate is the tax rate applied to your last dollar of income. Your effective tax rate is the average rate of tax that you pay on all of your income. The reason we have a marginal tax rate is to help determine how additional income is taxed. So again, if you are in the 22% tax rate and you're going to make that jump, you got a raise that's going to take you from $95,000 to $105,000. You need to know that, because that means that marginal tax rate jumps from 22 to 24%. However, you also need to know what your effective tax rate is. This reflects your overall tax burden. We figure your marginal tax rate is the highest tax bracket you fall into. And it's useful for evaluating the tax impact of your raises or bonuses. And by the way, bonuses are taxed as ordinary income, although it may be withheld at a higher rate. The effective tax rate, that's the average rate of tax you pay on all of your taxable income. It reflects your overall tax burden. It's basically your taxes owed divided by total income. And it's used for assessing your overall tax efficiency. Again, just because your last dollar was in the 24% tax bracket does not mean your entire income will be taxed at the 24% tax bracket. Now, this is published. It is available on the IRS website. I will have a link to it in the blog. And it's important to understand both rates. So you need to know, or at least have an idea of how much you're going to owe in taxes. I often will say, put a third of your money aside for taxes. Do I think that's too much? Actually, yes, I do. There's a couple reasons why I do that. One is, if you already have money aside in a high interest bearing account that's fairly liquid, it doesn't have to be very, very liquid like a checking account would be, but it could be in a money market where you actually have to call and get a sell order on it. It may take a few days to get the money to you. But I tell people, put a third of your income aside in that. Why? Well, one, at the end of the year, if you end up not owing taxes, you already have your money. Number two, you should have already been making quarterly federal tax deposits anyway. And the 30% is meant to cover not just your federal income tax burden, but your state income tax burden as well as self-employment tax, and that also goes on your 1040. So we want to make sure that you know how much of your income is going towards tax and how much you really have for other expenses. Now, there's one exception to this. This is going to work great if you have a flow-through entity, and your flow-through entities are S corps, partnerships, and sole proprietorships. As a reminder, your S corps, sole proprietorships, and partnerships can be set up as LLCs. So when I ask you, how is your business structured? Is it an LLC, a single owner LLC, or something else? This is what I'm referring to. I need to know if it's a flow-through entity, and I need to know which forms to file. So, however, if you are a C corporation, which is designed for bigger corporations, it's a flat 21%. So we don't have to do the tax bracket thing if you're a corporation. We have to figure out your income or your revenue less your expenses, figure out what your actual taxable income is for your C Corp, and then multiply that by 21%, and that gives us an idea of your debt burden, or gives us a pretty good what your tax burden will be. Now, the tricky thing with C Corps, again, is that we can deduct a whole lot of stuff. So, again, I will tell them, plan on 21% of your revenue, but understand your taxable income won't be that high. I would rather have you guess high on taxes and end up just keeping that money than one, trying to figure out, yes, I can certainly do it, but it's tougher to get into figuring out what your actual tax burden is on the fly than it is to do it as a annual reconciliation. That's what most people do. Yes, I can figure out how much you're going to owe pretty easily. But when we're just doing ballpark things and we're not making the tax deposits or anything, we want to make sure that we're guessing a little bit on the high side, because I'd rather you keep more of your money than to have to worry about interest and penalties. So what are some of the things that are going to affect your tax rate? One, your taxable income. That's the number one thing. If you're using tax-advantaged accounts such as IRAs, 401ks, and other retirement accounts, you can lower your taxable income. If you're a business owner, if you own a sole proprietorship, or even a side hustle, you can then write off some of your expenses and count that against any W-2 income, because a lot of these side hustles, at least on paper, will show a loss, and that can be deducted from the W-2 income. If you're expecting a raise or a bonus, knowing what your marginal tax rate is can help you figure out what the effect of that bonus or raise is going to have on your tax return. If you have refundable tax credits, such as the Earned Income Credit or the Child Tax Credit, this can substantially reduce your tax liability. And, every year those tax brackets change. So along with the blog post that I will have on my website, there will also be a link to the IRS's website where the 2024 tax brackets are published. I don't expect a big change. I haven't looked at them yet. I don't expect a big change. They're usually pretty close. There's going to be some changes for cost of living and inflation, but it's pretty simple to take care of. And they do change every year. So you need to make sure that you know what they are. However, it is fair to go off of the tax brackets from a previous year, because those brackets will probably only go up. I've never seen tax brackets go down. And knowing what last year's brackets are will help you plan for this year. A lot of people, you want to take control of your taxes. A lot of people kind of let taxes happen to them. Okay. However, if you know or you have a good idea of what bracket you're in, what your marginal rate is, what your effective rate is, it's going to give you more tools to be able to manage and plan your finances effectively. I am going to go into my woo-woo section here at the end, which is that money goes where it's wanted. And if you're treating your finances with care and concern, then you are more likely to bring in more revenue, make more money, save more in taxes, save more across the board, and be able to make smart financial decisions. I hope this is helpful, and I hope I've explained it well. Sometimes I don't explain it as well as I would like, although it makes perfect sense to me. And that's one of the great things about this podcast is I'm trying to push out as much good content as I can. And at the same time, explaining these concepts helps me do better as an accountant and it actually helps me serve my clientele. After all, if you can't explain it, you don't understand it. So if you have any questions, comments, concerns, if there's something you would like me to explain better, please let me know. If there's any topics you would like me to cover in upcoming podcasts, also please let me know. I'm very interested in making sure that I'm providing you with the content that helps you as you continue on your financial journey to wealth and financial freedom. Thanks, and I'm looking forward to talking to you soon.